Welcome to PhillipCapital's Weekly Market Watch. In the recent weeks, counters associated with rights offerings have taken a beating. Today, we have Ms. Madeline Chong, CFD dealer from Phillip Securities, who will share with us why there have been such negative responses to rights issue. So Madeline, what are rights issues?
In a rights issue, shares are offered to existing shareholders in proportion to their current holdings. Now, in a 1-for-4 rights, for every 4 shares that a shareholder has, he will be entitled to an additional share at a discounted rate. Now, shareholders who do not wish to subscribe to the rights issue have the option to sell the rights on the ready market. And rights have a dilutive effect on shareholders' holdings, and they do reduce the effectiveness of shareholders' voting rights.
Why are investors reacting negatively to the rights issues?
The slightest hint of a rights issue have triggered a large sell-down in share prices recently because such news sends out negative signals to the investors in a tight credit market. Now, investors who are worried that firms may be turning to the equity market as a last resort to raise cash. Firms, they can generally boost the cash flows in their books by borrowing money from the banks. But given the tight credit market, banks have been more stringent in their lending policies, even towards one another. Now, if the firms choose to have a secondary share offering, given that the investing climate is uncertain and cash is touted as king, investors who are risk averse will choose to hold on to their cash than to have the faith that the firms can survive in this long run, and so they will not part of their cash to subscribe to the secondary shares offering. If these alternatives are close to the companies, then one of the better ways to raise cash is probably through a rights offering. At least in a rights offering, investors who do not want to have their shareholdings to be diluted, they must fork out the cash to purchase the additional shares on offer. If they do not have the funds, then they will resort to borrowing to purchase the shares. This means instead of the firms who borrow the funds, now they transfer the task to the shareholders who have to borrow on their behalf. There is little direct impact on the share price of the firm if shareholders are willing and able to borrow the funds. So the problem really starts when shareholders are not able to finance the purchase of these rights issues, which can amount to hundreds of billions. And they begin to dispose their equity shareholdings, whether in full or partially. It will not be wise of these shareholders to let the rights lapse without subscribing for them, because this means that the average cost of their current holdings will not be reduced. It is also not quite possible to sell the huge amount of rights in the ready market given a short trading period. A collective action of many shareholders selling their shares at the same time will result in a depressed share price, and this is what we see in counters associated with rights issue right now.
What is the difference in treatment of rights issue in a bull run versus a bear?
Well, during the bull market, some of the company share prices rally upon announcement of a rights issue. Now, one of the possible reasons is that the funding from the rights issues then were used for companies' expansion. Now, investors see this as a positive event and will readily subscribe for the rights issue. And bear in mind too, back then, banks were lending readily. So it is unlikely that shareholders face funding issues like now. In fact, due to the easy lending policies back then, shareholders may have access funds to purchase even more shares in the ready market to get more discounted rights. Now, this results in a higher share price. I think regardless of the funding liquidity in the market, investors have to be cautious of highly geared companies which are using the funds from the rights issue to reduce the existing level of debt or to use them for their operating expenses. Such companies, they may continue to have funding problems after the cash raised from the rights issue have been exhausted.
Are there possible trading strategies traders can use in association with a rights issue?
From the points discussed so far, the general idea will be to short the counter that is associated with rights issue when funding is tight in the credit market, and to go long when there is excess liquidity in the market. Now, some clients who are a little bit more risk-loving, they can consider shorting the counter initially, then subsequently purchase the shares when the share price have been adjusted. This rationale is that we are assuming the institutional clients who can't afford the rights are selling their shareholdings before the come rights date, and after the ex-right date, they are re-entering the market to get back their initial exposure. A third strategy will be to do arbitraging, but I think this strategy may not be accessible for retail clients. They are probably only open to traders who have an extremely low cost of share execution. Other than trading strategies, I think for long-term investors, if you're looking to buy the shares at this point in time, instead of purchasing the shares outright on the ready market, consider the rights prices, because the value of the rights plus the subscribed share price may be cheaper than the ready market. So given the rights price is also cheaper, it can also result in lower brokerage commission.
Thank you, Madeline, for your time today. With that, we've come to the end of this week's Markets Watch. Tune in next week for more market updates.